Hello, everyone, and welcome to The Buck Stops Here. I am Catherine Murray. Well, I wanted to get caught up on the energy sector today. And for that, I wanted to bring you really a veteran in energy investing. Eric Nuttall is joining us now. He's the partner or a partner and senior portfolio manager at Ninepoint Partners. Eric, great to be able to catch up with you. I feel like it's been a while, and so it's certainly really well worth our time. It has been. So let me start there. Bring us up to date in terms of what we've been seeing within the energy sector, because we have seen oil pull back, but now we've kind of recouped some of those losses. So what's the sector looking like and the investment opportunities?
You bet. 2023 is unique because it really is a year of two halves. In the first half, with summer ending, the analogy I use is for energy investors, it was like my kids on a road trip asking, are we there yet? Are we there yet? Are we there yet? Because it's really required patience. We've had to see the seasonal uptick in demand strength, with Q1 being the weakest and progressively getting stronger. We've had to see the impact of supply cuts on the part of OPEC plus, Russia, and more specifically Saudi Arabia. We've had to see production impacts and whatnot. And our key thesis was just wait, be patient, because around July, what we're going to see is global oil inventories starting to fall by the fastest pace in history. And so now that we're 2 months into that trend, what we have is had exactly that, an implosion in global inventories as a signal of just how undersupplied the oil market is. And it's been that momentum that's been battling this ongoing recessionary narrative that we've been talking about for over a year. And it's obviously still hasn't shown up yet. So that's really been the cornerstone of 2023 so far. Stocks were weak earlier now, and now they seem to be finding their footing with the strength in crude.
Yeah, and thanks for bringing us up to date, because there has been a lot of push and pull, as you described, in terms of whether we're looking at the supply side of the equation and or this concern about this recession that everybody's saying, well, where is it? When is it happening? And is it getting pushed out to 2024? We'll get to that in a second. But I think one of the aspects that's been also difficult to incorporate in energy investing right now is what's been going on in China and the slowdown, the really dramatic slowdown that nobody really anticipated to such a degree. And a lot of people say, look, I can't really trust the numbers anyway. But, you know, I'm wondering how you think China's impacting the energy industry right now.
You bet. So it's a very good question to ask, because we're worried about a US recession, and now it's the worry of a Chinese recession. We're seeing a complete lack of correlation between the economic stats that are being released, which obviously signal weakness in manufacturing, more specifically in the property market, versus real-time stats that we use. So we subscribe to a firm called Rystad. They have a program called Real-Time Cube. They have an analyst team of over 100 people that track many variables. And I can tell you what Chinese demand yesterday was for diesel, gasoline, and jet fuel. We are seeing absolutely zero weakness coming from China as of like yesterday. And so there's this dichotomy or this divergence, and it's been true of what we saw in the US demand, which record high, versus this ongoing fear of recession. Now the fear of the day is China. And so it would seem natural to say, well, you know, you'll get a trickle down or getting trickle down from the property market into consumer demand, but real time, jet fuel demand. So domestic flights within China are well above 2019 levels. International has been lagging. That's been due to backlog in passport availability, in addition to just group travel not being allowed. That has finally been allowed as of about a week ago. And so you're starting to see international tick up. Diesel demand, both within China and globally, is actually inflecting up. The rate of growth is increasing over the past couple of weeks. So we're seeing absolutely no real-time indicators of demand weakness, either in China or globally.
Interesting. And what is your view, though, of the United States in terms of how you're anticipating the economy will play out? Because certainly that should have an impact on demand. You know, we'll see whether or not it's a big enough impact versus the supply shortage that we're talking about as well, though.
So we're already starting off in a chronically undersupplied situation. We have inventories well below average levels, even after the biggest release from SPR, which I now call the strategic political reserves in history. That's the starting point. If we have just a plain vanilla recession, what falls is not demand. What falls is the rate of growth in demand. So yes, if there's another COVID, if there's another great financial crisis where demand fell, then that's an issue. I don't think there are any mainstream people forecasting that. So even if there were a more plain vanilla recession, I'm not worried about demand faltering.
Okay. We're going to take a quick break. When we come back, we'll pick up on where the investment opportunities are, and also want to get your take as well from a macro perspective, what you're seeing in Canada. We'll be right back.